Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm delighted to welcome a very, very senior finance professional from Mumbai, India, Mr. Ankur Bansal. Ankur, welcome to the show.
Hi, Ashutosh. Thanks for having me over.
Thank you. Ankur is the co-founder of BlackSoil, which is the new age venture debt platform. So, Ankur, from equity to debt, tell me a little bit about your own journey.
Oh, that's like a very tough one actually. It's a literally a transpiration of many years. I
Hmm.
think it's literally I would believe it was not. I've never done debt like all our
Hmm.
life. I was either doing equity in terms of either capital markets or M&A. But the thing sort of just happened in front of us, and one thing led to the other, and we were suddenly doing debt transactions.
Hmm.
So what happened was that we were earlier. I was in investment banking at Citi and JP Morgan, etc.
Hmm.
And after that, I decided to do something of my own. So at that time, that was back in 2010. Still, entrepreneurship was not very famous as it is today. But I decided to do that, and but it was more on the advisory side that I was doing.
Hmm.
And in one of the transactions that we were advising one of our clients, that was a company, they had taken a strategic equity stake. We were a co-investor with Sequoia at that time. So this
Hmm.
is I'm talking about 2011.
Hmm.
So next 2 3 years, the company was in certain trouble, and at multiple times we ended up taking venture debt.
Hmm.
So we had a sort of a literally a view as at the board level or as a strategic equity investor taking debt, and we were quite amazed with the product because coming from the traditional background, we were amazed that somebody is giving lending to a company which is loss making.
Hmm.
So, and how that actually making sense without any personal guarantees, without any hard collateral, and there is still, there is a different kind of underwriting being taken care here,
Hmm.
and sort of that just amazed us because we ended up taking 2 3 times, and we saw how it got service, etc. and all.
Hmm.
And during the same period of time, from 2014 onwards, as you know, the startup boom happened, and we saw many of the startups started doing quite well. We were advising to some of them. So one of our first clients on the startup side was Oyo Rooms back in the day.
Hmm.
So that's where you started seeing what new economy businesses are looking like. Very different from what we had studied in our, our chartered accounting classes or CFA, etc. Very, very different from them.
Hmm.
And but it was very interesting how things were turning up. And as we started sort of transforming our business into the fund management business, and we got ourselves an NBFC license in 2016. The thing of our past, which was back in 2012, about how venture debt was done, we sort of was stuck with us, and that's what we
Hmm.
decided to take the plunge in that. And that's how our first 2 3 deals happened again with Sequoia backed companies of Nearby, Nolarity, and Homelane.
Hmm.
And we sort of then make this sort of as our core business now, starting off with maybe just a 30 crore modest AUM that time to today we are managing more than 1,000 crores.
Wow.
So in 6 years. So it's been a very interesting journey because the thesis was that there were a lot of equity guys,
Hmm.
but not many debt guys. And
Hmm.
no startup can keep growing only on equity. So the debt will also be shaping up and will be required and will become mainstream over a period of time. So
Hmm.
that was a thought. We didn't know how it will actually transpire. Not that we had any background on debt, but I think the ecosystem grew, and we got a chance to sort of play a role in that as well.
How interesting. So, for a lot of my viewers and listeners, before we go into any further questions, how is the debt fund different? Because most people know about equity funds.
So I think you're right. So in globally, credit funds are very common
Hmm.
because a lot of the institutional investors like to give in credit because obviously it has more principal protection being the most core objective of that you earn yield and you have a principal protection. In India, the typical way you make yield is you put in FD
Hmm.
and maybe some debt mutual funds again, which typically don't end up doing quite well.
Hmm.
So the only option that remains is the structured credit, structured debt funds.
Hmm.
There also the products that have been coming is typically for sophisticated and HNI investors. So it's not something that retail investors get access to. Typically, being much more complex products, and minimum 1 crore being the sort of the criteria. So you invest in these products assuming you earn a certain yield. So the yield can range from anywhere from a 12% IRR to up to a 20% IRR. If
Hmm.
you go into a real estate debt fund, which is focused on residential asset class, that will be promising you 19 20% IRR. So obviously
Hmm.
the risk, depending on the risk, you can sort of move up the curve. So there are
Correct.
all kinds of fixed income products out there on the credit side.
Hmm.
Venture debt is a little bit different in terms of that you earn the yield. You can expect as an investor maybe 13-14% IRR. Plus, you can have an equity upside because you have a product which gets attached to the debt, which is the warrant part.
Hmm.
So the equity upside can come in the form of warrants, which can obviously give a very substantial returns depending on the kind of companies you end up investing in and whether the companies end up doing well. And more importantly, as we see in today's times, you have to exit as well, right? So you may have paper valuation. So finally, that warrant has to see the light of the day in terms of an exit.
Hmm.
But theoretically, because the warrants are backdated, as in they are long dated, they have like 6 to 7 years kind of a time horizon, you get enough time to sort of get the warrants in the money. So unless the business model itself was flawed from the beginning in terms of not creating equity value for the stakeholders,
Right.
as a warrant holder, if you have like in any company, you may have like a fund may have 25-30 companies. So even if you assume 10 companies will do well, that could give a substantial return on the warrant upside itself. So the product becomes very interesting because the problem for most HNIs is that you invest in funds and then you don't see exit till
Correct.
5 years, 7 years.
Hmm.
But in a debt fund, you get your capital back very quickly because it's a 2 year horizon, 3 year horizon paper. So money is coming back and equity upside can come at the end of 6 years or 7 years, depending on that. So it sort of plays very well in the middle of
Yeah.
the entire asset class.
Hmm. And of course, the other advantage from an entrepreneur or a startup founder's perspective is that their equity doesn't get diluted.
Yes, of course. So that from a founder perspective, that is one big sort of advantage. Second advantage is which I feel is also very important is the organization gets very disciplined because when you take debt, you have to return the capital, which is not typically most companies come with that perspective, right?
Correct.
And you become in now today's time everybody anyway talking about capital efficiency, but most founders which are understand the value of capital, understand taking debt early on so that they can build their business model accordingly, especially businesses which require working capital. So it makes sense to use working capital being financed using debt than using equity, right? Because even this is expensive, it's still cheaper than the equity portion.
Very interesting. One of the other challenges that has traditionally been there of debt, and I'm not talking of when in my days when if you ever wanted any debt, you go to a bank and they would take everything you have, including your shirt on your back, as collateral. How do you, de-risk or securitize your funds?
Yeah, I think as a lender, I'll be saying something which is maybe sort of an antithesis. We don't get comfortable by security because if we have to go and invoke security, India is not the market one has to be operating in because you may have the best real estate asset also, but you can ask anybody who's sort of been in that business that it may take years for you to be able to really liquidate that asset.
Yeah.
So security is more of a mental comfort. From an investor perspective or from a perspective of from as a fund manager, but actually the underwriting is more important. That are you getting into a business which we see potential in? So that's where we try to spend more time on. So that's where the equity mindset helps a lot because these businesses cannot work with a traditional debt mindset because if you're trying to put a security package together, typically it will not sort of make sense because of the fact that these are businesses which are loss making and they don't really have any hard assets. And even if you take suppose a promoter's or founder's pledge of shares, it has limited value because you cannot sell the founder's shares itself. If the founder is not there, what is the value of the company?
Correct.
So you have to sort of take a full bird's eye view on the business itself and take a call on that. And of course, the fact there are VC investors in it obviously helps a lot because they have also put in capital and their time behind it. And they reach a certain stage where a business can take debt. So it's not that every business that comes our way, we can take debt, right? So typically they have raised at least $10-15 million. So are at growth stage. So they're not necessarily figuring out their product market fit. They're not figuring out who's the first customer and all of that. That level, typically, I will not advise, nor typically will be able to get some debt. So the security as such comes a little differently. Because somebody has put 100 rupees in the company, we do not give beyond 15-20 rupees in the company. So the skin in the game on the equity side is very high. It's more be 3-5 times of the lender. Versus a normal company or a real estate asset, for example. In real estate, developer would have put in 10 rupees and the financer has put 80 to 90 rupees. So the risk is completely on the lender. So he has to sort of ensure the asset runs. For most of these, that's why the Indian founders or promoters of the traditional world are like, okay, the banks have to manage the risk. It is they are sitting
Correct.
comfortably
Yeah.
because skin is from the banks. Here is the other way around. So the
Well said.
VC investors as well as the founders have enough skin versus what the lender is bringing on the table, because we are not substituting equity. If we come into substitution of equity, then it's a very different business altogether.
Absolutely. I agree. And are there any particular sectors that you focus on, or are you sector agnostic?
No, we are sector agnostic. So there is I think debt plays a very interesting use case across sectors. So whether it is a consumer internet company, a D2C brand, B2B e-commerce business, or even a healthcare brand. So, across business models, we've been able to play an active role on that.
Very interesting. My next question to you, and this has often been asked, is that at what stage should a startup entrepreneur look for funding, and how much debt funding should they seek along with equity funding?
So I think, as I mentioned earlier, that we should start only once you have reached a certain scale of maturity of the business. So of course, maturity not being that you have been in business for 10 years, but at least you have a consistency of over 6 to 12 months of revenue and certain margins being you're able to predict much more comfortably. So that's where lenders start getting more comfortable. In terms of if you're looking at the kind of equity or the debt that they should maintain, typically beyond 20-25% of the total equity around, no lender will typically give you. So that's what the ratio we try to maintain on every round if you're co-investing along an equity round. But if a lot of our transactions happen when there is no equity happening, so we take a call of total of 20% max of the total equity in the company. So if company raise 100 crores, we'll give up to 20 crores, that kind of a number. So that's how we sort of try to maintain the sort of a ratio to some extent. We don't really give a lot of value to the valuation of the company, because as you know, today's times the valuations can change very, very rapidly.
Correct.
So if you ask me, our portfolio company valuations, we don't really track also, because it's not our cup of tea, because that will just give you a false hope that our portfolio values XYZ, but you can't really transact when it really need to.
Well said. Well said. My next question to you is that, as someone who has a stake, when I say stake, a debt stake in the company, what kind of governance do you get involved in for a company where you've given money?
So we are not active investors. I would say we are very active from a debt investor perspective. If you compare with regular debt investors, we are from an equity investor, we're definitely passive. But for us, monitoring the companies is critical. So we continue monitoring this business on a monthly basis. We are not part of board calls, but we get our monthly MIS and we are able to track that very, very closely with the business plan. And we do our monthly or, even maybe sometimes bi-monthly conversations with the companies to get a sense of what is happening in the business, and maybe occasionally even with the VC investors if we see things are sort of going awry. So that's how we sort of keep a track of it. A lot of information sharing obligations are there with these companies, typically when we enter into any kind of lending arrangement, so that we get a good sense about what's happening in these businesses. And for obvious reasons, because the business could look very different 6 months down the line. So if there is something changing rapidly, we should be aware of it. Because many times the startup founders have so many things going on for them. They will not really think, okay, what I had some covenant with a lender and that might get breached. So you have to be on top of it. And for many of them, we may end up being the first, lender itself. So they don't really know how to sometimes manage the lender. Manage may be a wrong word, or how to deal with the lender. And how to keep them apprised of it. So we have seen all kinds of portfolio companies. Some people like to keep you posted even a quarter in advance what's happening. Some people call you 24 hours before some news items are going to come in. So they like to treat you as any other investor you would treat, except the fact that maybe you're not part of a decision making process at the at the board level. But they are the most mature guys are happy to take feedback all the time. They are like, okay, because people like us have access to many different kinds of portfolio companies, even sometimes competing portfolio companies. So you get data points from different sources, and we can sort of sometimes give a very independent view about what's happening in the market, as well as what's happening in the space, or etc. What we are seeing, which could be interesting from their perspective. So it's literally how much open or receptive some of these founders are on the basis of which one ends up developing a relationship with.
Correct. And Ankur, how does the cost of a debt fund work? I mean, is it something which is similar to what banks charge? Is it a premium cost because of the convenience with which they're getting the money? How does that work?
Of course, the pricing is very different because that's literally my first call with any founder is if you can raise money from banks. So let's not chat because you
Correct.
can all if it makes sense if you can do it, then might as well do that because nobody, even NBFCs, large NBFCs can't compete with banks in terms of pricing, right? Because of the CASA that they have. So as most of our venture debt funds like us are raise money from HNIs and family offices and institutions. So the pricing is what those kind of investors are looking for. And as I mentioned, net of fees, they are typically expecting like 14-15% IRR, the investors itself. So on top of it, you have to add our management fees, etc. So the deal IRR becomes almost close to like 16 to 18%, right? So that's where the pricing becomes on an IRR perspective. On a coupon basis, that could look like anywhere from 13 to 15%, depending upon the kind of risk that one is sort of underwriting.
Very interesting. Couple more questions, then I'll move to BlackSoil Advisory. How important is the leadership team when you make an evaluation?
I think you're betting the horse, right? So betting the jockey, you need the very critical to know what the jockey is like, right? So you have to look at everything in total. It's very similar to any investment that you'll do, even in the public market space or whether it's the unlisted space. Some of those things will not change because finally the founder and his thought process and the management team is carrying along is extremely critical because you are getting into a relationship with them possibly for 2 to 3 years, and there will be times which we may have to work in things which we had never planned about. So keeping that in mind, you need to see that guy is something that you can really bet on. Of course, it's finally there is no specific matrix under which you can say this is a good founder or that is a bad founder. There's nothing like that. But what he's trying to sort of do, his vision, and how is he doing it. Many times what happens is the founders are saying something, but they're doing something else, right? And we believe like numbers typically don't lie. So if what you're saying about numbers are saying exactly are in toto, that sort of gives us a lot of comfort that, the company is actually on the path that they're trying to be on. And those things sort of become very important for us. And the question that you had previously about how transparent they are, how well they take feedback, how well they are sort of, informing us, keeping us in loop, that sort of helps us. Now, we have done more than 100 deals in the space. So now you start trying to put some founders in certain brackets, okay, whether this is somebody you'll be able to work with or not. So that's how sort of your mind starts sort of working with, and how they are obviously passionate. Most of the founders are passionate. Even somebody who's a early stage founder is also very passionate. So just passionate cannot be the reason one can fund, but how practical they are, how pragmatic they are, how much their feet is on the ground, and how much they are close to reality is important to understand also.
Interesting. And every private equity fund, venture fund, debt fund will always have some ones that got away. Where you say, you take a call not to do it, and then later on, I wish I had done it.
Okay.
Do you have any such organizations?
So as we call it, anti-portfolio, we'll always have. I think on the debt side, I think there will be a couple of them. I think Eruditus and Shiprocket. I think these are the two big ones that we didn't end up closing. More to do with the fact that maybe we were not fast enough sometimes to move, and sometimes maybe we're not. What do you say? Pricing wise, not aggressive enough. So that sometimes happens. But that's the game, right? So as I heard from another panelist from the VC side, he said our business is like a bus stop, right? One bus will go, another bus will come. So that's how it is. So it is what you learn from it.
Absolutely, I agree. So let's now talk a little bit about BlackSoil Advisory.
Sure.
What kind of work are you doing here?
So BlackSoil Advisory used to be our earlier firm, where we used to do these advisory services for M&A and all. So now that was a group firm. Now it is sort of not really actually active. So BlackSoil Capital is our main firm, which is our NBFC space. So that is where our entire lending activities is happening. So we have a sort of a unique structure that we have an NBFC as well as a credit fund. under which we are doing our entire this venture debt and venture lending activities.
Okay.
So these both two different as sort of platforms we have to sort of finance the multiple startups, etc., and growth companies that are coming our way. So the NBFC gives us a opportunity to leverage ourselves. So whatever equity we have raised from our sponsors, we are able to leverage it and obviously, work like how a typical bank would do, and create better ROE for our investors. So that's one opportunity. And second is to earn fees typically from our credit fund.
Correct. Well said. And my last question to you, Ankur, now, and this is for the many, many people who will listen to our conversation.
Sure.
Based on your own amazing journey, first in the equity space, now in the debt space, and having done, must have spoken to God knows how many hundreds of entrepreneurs, funded, I don't know how many, even BlackSoil, you said you funded over 100 people.
Yeah.
What would you say are 3 learnings or 3 lessons that you would want our viewers and listeners to take away from your own journey and from our conversation?
Okay, that's a tough one. It's very difficult to summarize in 3 points. I think from an investor perspective, investors had perspective, I think first most important thing is to not get into FOMO. I think that is the biggest important point. I think it's very easy said and done, but I think we try to follow that as much as possible. And in that FOMO, the second point I will link is that one should stick to their underwriting thesis. So what you should only sort of play in that area, not get into areas or adventures or ventures which result into adventures which sort of are beyond your underwriting or your understanding capability. So stick to your thesis and focus on that. And third, you need to have a great team alongside. So you can't do this by yourself. So you need to have an awesome team supporting you in this journey. So you need to sort of have similar North Stars or things which keep the entire team motivated. Otherwise, it's very difficult to be on this journey by yourself, especially in our business where you're working with, like, any point of time with more than 50, 60 portfolio companies. So you need to have a very strong platform, process, systems, and team sort of to help you grow the platform. Otherwise, will end up becoming a niche player.
Very interesting. And on that note, Ankur, and your 3 wonderful lessons, don't get into this fear of missing out syndrome. A lot of us tend to do that.
Yes.
Second is stay with your underwriting thesis. And third is must have a great team. Thank you so much for speaking to me on BlackSoil Capital, about your own journey from equity to debt, about all the things that you look at before you make a debt investment. Thank you also for talking to me about so many different aspects of debt funding. Thank you and good luck.
Thank you, Ashu. It was really fun having this conversation Tuesday morning. Thank you.
Thank you. Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.